People often say we need to learn Warren Buffett's investment philosophy. But let's start with a sharp hypothetical question. If Warren Buffett had been born in China, would he have had the chance to become the richest person? The answer is no. Look at the 2026 rich list. America's top billionaires are backed by giant companies worth trillions of dollars that grow rapidly around the world. Just compare the stock market performance of the past decade across Hong Kong, China, the UK, and the US. While markets in Hong Kong, mainland China, and the UK have experienced extended periods of stagnation or slow growth, the US stock market has surged relentlessly, driven by tech giants worth trillions of dollars. This massive gap in performance clearly tells us the environment and system fundamentally decide how fast and how big a market can grow, and how billionaires are made. Therefore, when we decide to follow a certain investor strategy, we must first ask 4 questions. Why did they succeed? Is the market environment right? Can I actually do this myself? And is this method easy to copy? If we don't figure these things out and just blindly copy them, we will only end up making fools of ourselves. First, pick the right market. Why your main battlefield must be US stocks. Building directly on that macro reality, we find that Warren Buffett's massive success is inextricably linked to his roots in the US market. Setting aside his recent investments in Japanese trading houses, the vast majority of his time and assets over decades of investing have been allocated to the US market. If you do not participate in US stocks at all, yet want to apply Buffett's strategy, you are fundamentally deviating from its essence. The US market possesses several unique advantages. A relatively independent judicial system and institutions that safeguard long-term corporate development, where companies can even win lawsuits against the government. At the same time, it gathers a large number of enterprises that genuinely hold global leadership positions across technology, finance, and consumer sectors. In other words, the overall national strength of the US and the resilience and stability of its leading companies are hard for other markets to match. That is why, to truly learn from Buffett, the primary prerequisite is simple. You must shift your investment horizon and asset allocation toward US stocks. Next, focus on business essentials while ignoring short-term noise. Once you are in the right market, your daily focus must shift. The core of value investing is analyzing a company's profitability and economic moat, adhering in principle to not obsessing over stock prices. Buffett's core principle has never been whether a stock will go up or down tomorrow, but rather, is the fundamental nature of this business good enough? He often says, price is what you pay, value is what you get. Short-term price swings are practically noise to him. Imagine this. If you buy a stock and your emotions fluctuate wildly with the market, every day panicking when it drops 5% today, overjoyed when it rises 5% tomorrow, you simply cannot practice value investing with that mindset. If you cannot overcome this hurdle, you are not suited to learning from Buffett. Then, choose resilient business models run by ordinary management. With the right mindset toward prices, the next logical step is selecting the right kind of companies. Examine whether your chosen investment targets belong to businesses that an idiot can run, because one day one will. Looking back at Buffett's classic early holdings, Coca-Cola, American Express, See's Candies, Geico, almost all of them are human life essentials or businesses with powerful brand moats. Even Apple, which he has heavily invested in recent years, can be regarded as an indispensable lifestyle ecosystem today once you enter Apple's system. Switching costs are extremely high, making it almost like a daily essential. If you choose high-growth, high-risk tech stocks whose survival over the next few years is difficult to predict, yet claim you are doing value investing, you are putting the cart before the horse. Because for such enterprises, it is fundamentally impossible to reasonably predict their fate 10 or 20 years down the line. Finally, prepare yourself for long periods of underperformance. Even if you get the market, the mindset, and the targets right, you must clear the ultimate mental barrier. Even if the direction is completely correct, value investing will inevitably underperform the broader market significantly during a stock market boom. You must never waver because of short-term lagging. The most classic historical example is the dot-com bubble of the late 1990s. At that time, the market was wildly chasing internet stocks, and Buffett was mocked by the media as over the hill because he didn't touch technology he didn't understand. He lagged significantly behind the major market index for several consecutive years. It wasn't until the bubble burst that people realized once again, true returns are measured in units of decades. The question is, when the broad market is soaring and your portfolio is losing money or lagging far behind the market, can you actually bear this psychological pressure? If you cannot cross this threshold, Buffett's method is not for you. Buffett is undoubtedly one of the most outstanding investors of our time. But to emulate his path, one must first thoroughly understand its essence, the market environment, the nature of the business, and most importantly, your own psychological structure. Even if you mastered 100% of his operational methods, it would be extremely difficult to practically execute them on a psychological level. True value investing has never been a casually reproducible formula. Rather, it is a lifestyle that requires a high degree of self-awareness. If you agree with today's sharing, feel free to subscribe to the channel and give a thumbs up for support. See you in the next episode.